The main part of the payable management is to make sure that we are paying on time and taking advantage of the credit period which is extended by the supplier. Whether we should choose cash on delivery, whether we choose cash before delivery, or a 30-day credit or 50-day credit, usually the decisions will come from the analysis of what are the differences in prices, how much discount are we getting if we pay cash on delivery or paying advance, versus what is the difference if we use that credit. So we can always check what is our equivalent annualized rate, equivalent EAR, and then compare that with our own cost of financing, whether we are saving money or we are not saving money, right? In this example, what's the effective annual rate for credit term that we have already discussed how we calculate the credit term. If you get 15 days, if you pay within 15 days, you get 1% discount, but otherwise you have to pay for 40 days. If the firm stretch the accounts payable to 60 days, let's say, if they discuss with them, what about if we stretch it to 60 days, what would be my EAR, right? The first thing you have to do is, since we are calculating this $1, we are stretching these by 15 days, so you are utilizing this $1 for not for 25 days like in our previous example we see. Now we are using it for 60 days, right? So 60 minus 15, so we are now using this $1 for 45 days. There will be 45-day periods when we are calculating, so there are around 8.1 45-day periods in a year. So the effective annual rate will become 8.49%. I hope you remember how we get 1 over 99. We need to pay $100. So 1% discount will become $1. And since we are paying 99 first, so we are basically paying $1 interest for 45 days over 99. 1 over 99 percentage, in terms of percentage, this interest we are paying 1.01 for 45 days. So if you calculate how much is my annualized rate, that becomes 8.49%. Now you can compare this rate with your own financing, with your own bank cost, whether it's you should stretch or you should not stretch, or how far you can stretch. So if, let's say, you have to pay to the bank less than 8.49%, so it's better not to stretch it but to pay in time and utilize the bank interest rather than extending the credit and taking an advantage of paying 1% extra for utilizing any time of credit. If your bank interest is higher, then you can stretch this as long as you can with the discussion of the supplier to control your cost of financing. If you are not taking anything on loan, means there is no financing, you don't have to pay any kind of interest, then better to look at the earnings potential, how you are going to use this money that you are saving, $99 for 45 days. Are you able to get more return than what the equalized annual rate is suggesting? If yes, then we can hold it and pay later. Otherwise, it's better to pay within the discounted period of time, right? So you need to understand these terms so that you can make decisions whether to pay in time, I mean take the advantage of the discount period, or you want to stretch. Let's look at the inventory management. Inventory management, as you would know, holding up your raw material, your finished goods, it requires business to invest money into the inventory, not only in terms of purchasing it, but also the cost of storing it, right? There is usually a space requirement, there is usually a people's requirement to issue out from the inventory, to keep in the inventory, to do the accounting for inventory, to count every year, every month, and then also electricity, utilities, maintenance, cleaning, and all those kind of things are costs associated with the inventory. So the business need to first identify what are the costs of holding the inventory, and then what are the benefits of holding the inventory. So the benefit of holding the inventory is basically it helps you to minimize the firm that you are in a position of stock out. That's the only benefit that you see. In case of any emergency, you always can use your built up inventory in your outlets, in your warehouse. You can use those stock in case of emergency, so you are not facing a stock out position. You can maximize your stocking in emergency situations. Seasonality again will help to match the production cycle during non-season. So normally companies have to store the items which are seasonal, right? For example, in hotels we have to store certain fruits which are seasonal only in our cold storage, so that during the whole cycle we can still provide the services to those company to our guests, right? But again, it depends on what are the priorities of the companies. Maybe are we changing the menus, or are we changing our products line to match the seasonal shift in ingredients? If yes, then you don't need to store, but if no, then you have to keep high storage. So that's the benefit. But then, as I discussed, as I shared earlier, the cost of holding the inventory are its acquisition cost. The higher inventory you hold, the higher is the acquisition. So acquisition cost will also include your financing cost, the one that you have to pay to your suppliers, the interest if you have any, if you're taking money on the loan. Then also the ordering cost. Every time you have to order, you don't have to pay anything for ordering, but you have to pay for the delivery, correct? So anytime you order, there is a transportation, logistic, and then maybe the telephone cost or the other type of, or you may have to go to the visit, or you are order the inventory. So these are all add up cost. Every time you make an order, there is the order cost. Then there are carrying costs, your space rental, your insurance, your cleaning services, your manning to look at the space. So those are all the cost of holding the inventory. So you have to understand what are the cost of holding the inventory, and then we can look at how is it beneficial for us to hold a high inventory or not. Usually there are certain practices which companies are now have started to use, such as just-in-time inventory management, which mentions that you are going to acquire inventory only to its requirement in the immediate needs. So you're not going to stock very high. There is always a lead time when you order, and time of delivery from your suppliers. So you may want to keep an inventory up to that lead time only. After that, you can always continue to fill up your inventory as and when you are consuming. Just-in-time inventory management requires you to study the supply chain possibilities and the easiness of movement. It may be dangerous if, let's say, there was a very recent case on Suez Canal, right, where the supply chain was hold up for many days. So if the companies are following just-in-time inventory management, they would be in a very difficult position, correct? Because anytime these kind of disruptions happen, their entire supply chain would be problematic. They have to even shut down the plants. So you always have to have some sort of backup, looking at the geographical conditions in the country where you are and your supply chain, where the supplies are coming from. Would there be any risk? You may have to prepare some backup, right? Maybe you don't have to hold it, but you may have to have certain insurance or certain other suppliers who may immediately jump in and provide you those inventory things. So that's the inventory management. You may have learned on other modules on managing the supply chain. So that's not a part of the financing. The corporate finance side of inventory management is to just analyze the cost of maintaining it and the benefits coming out of it, right? So the benefits, as we have discussed, reduce the stock outs, make the operation smooth, customer relationship, increase the sales, but they are not really directly measurable. The cost, however, are measurable, right? So interest on funds used to acquire inventory, storage, security, cleaning, insurance, taxes, theft, spoilage, and breakage. So these are the normal cost of inventory, maintaining any kind of inventory, whether it's adequate or extra. So these costs you can always measure how much is the cost of managing the inventory, and you can always compare. The benefits are not really directly measurable, but you can have some measurements like delivery times, or is there any impact on the loss of sales due to the stock out position and your competitive position. If you are always frequently stock out, then your regular customers can go to your competitors and obsolete. So there is a economic order quantity model. This model is very old. It's gonna just only tell you what is the optimal order size. So it's not the optimum inventory style, how much inventory you need to carry, determined based on the lead time of your inventory, each and every product, how much is the lead time that is needed, how much minimum stock I need to maintain. In hotels, we have par levels. I don't know about the other industries, but we have an optimal level of inventory that we need to maintain at any point of time, given the customer orders. For example, for beverages, we have par levels that, okay, we will have maybe 5 bottles of this wine, 5 bottles of that wine, and 2 bottles of this wine, depending on the customer requirements at that point of time. The grocery stores, They also have their power levels, how much they are going to put on the shelf based on how fast the things are moving. So if let's say every day you are selling 10 pieces of equipments, right, 10 pieces of iPhones, right, and you know that in order to get any new inventory you have to wait for a month, so you always have at least 300 phones in your stock, so that you have inventory of 1 month before you order anything. So you will always have that. Whenever you sell everything, you need to start replenishing it immediately, right? But when you are deciding the power levels, you also need to estimate what is the minimum order that you need to maintain for what is the minimum size of inventory that will come at that point of time, how much it will take to arrive, and how long it will take for you to be able to survive. So you have to keep a minimum amount in your inventory. That's how the power levels are set up. The main considerations are the estimated sales, the lead time, how much is the minimum time supplier will take you to deliver, and the minimum order size, how much is the order size that you need to order. Companies can always calculate the economic order quantity, how much is the normal they have to maintain if they want to optimize the cost of ordering and cost of storage. So that model basically works like this. We identify the cost associated with the inventory, but we don't really consider the discounts, the bulk discounts, and also the varying prices based on the quantity to be ordered. So we have a fixed price of the inventory. If there are bulk discounts available, then the economic order quantity model will not work for you, right? Yeah, this is the economic order variable formula. How we calculate this is the formula. So the economic order quantity, the formula is 2 into fixed cost per order, if there is any fixed cost, multiply by the annual demand, divide by average carrying cost per unit, and then you take a square root of this. So this will help you to understand what is the economic order quantity for each. Now, how will you get the information? The fixed cost per order is going to be your delivery cost, your ordering cost, your maybe payment transfer cost. So that will become your fixed order per cost, right? Then you have the annual demand, which you have to estimate based on your past and based on your future business outlook, how much of the unit that you think you will need, right? Then you have to divide this by average carrying cost per unit. So how will you get that? You have to estimate this by adding the insurance cost, adding any electricity cost, adding any cleaning cost per unit. So now here you are discussing the per unit cost, right? So in your warehouse, you may have multiple items lying in your warehouse. How will you get the carrying cost per unit? You may have to devise a method how where maybe you were to take average of all the items that are lying there, and then calculate the cost per item, how many units of those items are there, and then you calculate average carrying cost per unit on an average basis. So you have to look at your past history of your warehouse rental and or the cleaning cost, electricity cost, and everything else, and that will help you to understand what is your annual carrying cost. You have to remember certain costs are sunk, right? If you have it already, and they may not change based on how much you are ordering. So only the additional things that you have considered, like additional space requirements, additional cleaning requirements, additional insurance, so those are the annual carrying costs. So you have to consider that those only. Don't add the sunk cost, which are already incurred and you have no control of those costs anymore. Maybe you want to do a little bit of exercise, small exercise, to understand. You may want to do certain things like we set up the power level, right? So as I was discussing, apart from identifying how much is the minimum order quantity, the other aspect of doing the inventory management is to understand what is my safety stock, what are my reorder points, and the lead times. So basically the safety stocks means your power, right? Minimum amount that you need to carry at all times so that you can use them when the stocks are running out. Because the stocks, when normally you look, it will work like this, right? You have some stock in your hand, over a period of time you will use them, and then it will start to go down, correct? And then you will make a reorder again, and then your stock will again be very high, and then you will continue to use them over a period of time, and it will continue to go down, and then again there will be a spike because you are ordering again, and so everything will go up, and then you will again down. So this is a normal seasonal cycle, right? But the question is how much minimum you should keep in your stock, because you don't want to have a situation where everything has run out, right? So you need to have some safety stocks so that you can maintain your stocks to a minimum level in case of any emergency. So that amount the company has to decide based on their experience. So the safety stock would mean that it's an additional inventory that you need to carry at all the times, no matter what, right? Minimum is this much. This is not to be confused with the reorder points. The reorder points normally is when you have to place a new order. By the time the order is coming, your stocks will reduce to the minimum order, minimum level. That will become the safety stock. So the safety stock, you can consider a simple formula, that how much lead time it takes and what would be the consumption during that period. Maybe let's say if the lead time is 14 days, when you place the order, a new supplier will be delivering you in 14 days. Then if let's say you are consuming 50 units a day, then it means you need to maintain at least 700 units in your safety stock as a minimum, right? But there may be always challenges. So supplier can say, okay, my normal lead time is 14, but it can go up to 21 days. So maybe I will deliver within 14 to 21 days. So company may not want to take a risk, right, of being a stock out situation. So it may always say, okay, the maximum, maybe another 3-4 days just in case of any emergency that is happening. So the companies have to decide how reliable is the supply chain, how fast they can replace if there is any problem, right? So you may always say the lead time plus certain time period, maybe 2 days, 3 days, 4 days or 5 days or whatever number of days you want to add up as a safety, as an insurance. You need to keep that in mind and then work out your minimum stock level. That will become your minimum stock level. How are you going to determine the reorder points? So your reorder points will be your minimum level plus the lead plus your consumption during the lead time, so that you have enough of stocks before you run out of them, right? That is the reorder points. You have to identify the reorder points, but we don't get confused with the economic order quantity. It's a reorder point at which level, when the stock is falling down, when we have to issue the order again, so that by the time our stocks reach to the minimum level, we should be able to get a new inventory, right? So that is the point. So you can understand this as a pattern, as we have already discussed, is you have some safety stock in your hands, and then the reorder point is a slightly higher based on the lead time. So this is the lead time. So the difference here is the lead time. So you always have to maintain your reorder point so that by the time you consume the things, you are always able to get the new orders, new inventory before you are able to consume anything below your safety stock. So you should not be falling below the safety stock. You have to have that always. If there is a high usage, you may fall below safety usage before your safety stock, but in that case you can always order earlier depending on how well you are how often you are looking at your inventory report. In hotels, they look at almost every week the inventory, and so that they can make sure whatever is coming out they can always fill, right? If there is a delayed inventory, again should be able to estimate how much is the maximum delayed inventory, so that you are not falling below your safety stock is able to cover for your delays as well. Now, how much you need to order? What is the maximum order that you should do? So normally companies also set up a maximum order. How much is the maximum that I want to keep in my stock? So that maximum amount is the safety stock plus minimum order amount. So that is the maximum of the stock. Usually the estimated consumption over a period of time. So you want to keep a stock for maximum of 2 months, maximum of 3 months, depending again on the turnover of the things in the industry. So let's say if highly susceptible to obsolete, trend of changing fashion, if there is a trend of changing the technology, then you may want to reduce your inventory to a level where you think that if let's say within you expect a 2 months, every 2 months, every 3 months, every 4 months, every 5 months consumer behavior change, you don't want to keep a high inventory in your stock. For example, Samsung, if they are going to Samsung store, if they are going to refill an inventory, let's say in July, they know by August, September the competitors are launching new models, or the companies are going to launch the new models, so they will have to adjust their orders to, so that they don't keep too much of old models, right? So that's how we normally have to decide. So you have to basically identify the levels of your stock, safety stock. What is your minimum inventory that every time you have to carry no matter what? Then you have to identify a reorder point, at what point we will be reordering the items, and that reorder point will depend on the lead time and the estimated consumption during that point of time, right? So you will be able to estimate how much is my consumption in the next 1 month, 2 month, 3 month, depending on what is the lead period, and then you will calculate the reorder point, right? And then you also have to define how much to order. So how much to order will be defined by the economic order quantity model or just in time approach, the one whichever you are following. If you want to order smaller quantity, and also it depends on what is the order cost, right? If let's say the items are imported, the cost of freight will be super high compared to a local inventory. So if it's a local inventory, you may not want to order very high amount. You can order because you can always replenish it faster. But if it's the servicing cost of the inventory is smaller, so you have to work out on different models. I can't give you enough examples to be able to cover all the aspects, but the practice, the concepts are there, which you have to minimize your order fulfillment cost, and also make sure that you are not taking too so you have some maximum order in order limits in your inventory. How much maximum inventory I want to keep, again depending on the business requirements, and also the how fast the inventory or the technology is moving in that particular space. Another point of monitoring the inventory. Now this is the planning of inventory, right? So every now and then, every month, you have to look at your slow moving reports and non-moving reports. So slow moving reports by industry standard is something which has not moved in last 3 months. Non-moving inventory items are something which has not moved in last 6 months. That's normally industry standard in all the industries. So you have to look at those reports and see, are there any items which are not moving? If not, then why not, right? And also you have to reflect, why did we buy a certain item, it did not move? Is it we ordered too much, or there was no consumption? If no consumption, why we were not able to identify that there will be less consumption? So why we didn't adjust our order? Not to blame the person who is making the order, but to understand how we should protect in the future. So that's a very, very important aspect of inventory management. This is the first planning, is the planning, and the second is the monitoring part. So the safety stock should not be change economic order quantity, because it's just a safety stock. It's not going to be changing it. But there is always a cost trade-off. Extra inventory increase carrying cost, but it avoids loss on the production delays and missed sales. So you always have to have safety stock, even though it's gonna cost extra money, right, to carry them. The another way of i.e. monitoring the inventory is called ABC system. Are you using ABC system? So ABC system is basically it's a Japanese system where they segregate the items by the value and they place tighter control on high cost pieces. So A means it's a very expensive item per unit, not a total value per piece, and is very critical for operations. Either it's very expensive per unit, or it's very critical to the operation because it's a bottleneck. If without this, the operation would stop, right? There are certain items like this, right? Those we place under A. It means that we cannot find the alternative, and it's super expensive and it's easy to theft. Those are under A items. So they need to have a proper, very tight control. Means maybe their inventory is looked at every day, so that we make sure that nothing is missing. Their inventories balances are looked at every day, so that we ensure that enough stock is always available. Their physical condition is good, is usable, not expired, and all those kind of things. So you have to have a very high control on those items. Then there are a B item. The item B, classify as B, usually would be the items which are high in volume and second highest in the prices. So either they are modest in pricing or high in value in total, not by unit price, but in total they are among the top 5 or top 10. So if they are high in volume, high in consumption, but may not be very or fast moving, right? We're moving at a very fast pace, even though they may not be very expensive like A, or they may not be very critical, but they are fast moving and they to be kept in a slightly tighter control, those items will be falling in B. Here you may want to say, okay, maybe we look at them weekly or monthly. Then there are items C, which are cheap and plentiful, means that they are cheaper in value, or they are not moving very fast, or they can be replaced with something else very easily. If let's say the item cannot be replaced with something else and is critical for the consumption, even if they would be cheap, they would be under A, especially because they are not replaceable and they are not easy to find. But if the item is easy to find, for example, like sugar or salt, you can find anything, you can use any brand, you can use it, you can find it very easily, right? You don't need to keep them in a high value. They are item C. So item C, the physical controls and analytical controls are very low, because you don't have to worry about them. You can do monthly or a quarterly or a 6-monthly basis. In a buy standard, A items are usually your 15% of your total inventory. I mean, if let's say you have 100 items in your inventory or your usage or your production, 10 to 15 items should be under A, would be under A by law. If they are more than that, then your classification may not be correct. And the 8B items would be covering the volume, the value of your inventory by almost 50 to 60%. Then the C would be the balance, maybe around, they would be under volume, the value would be the lowest, right? So they are low 20% and in terms of value. So that's classification. So A, B, C. That is very important for businesses to identify what is my top priority items, what is my modest priority items, and the C is the cheapest item. So you don't have to really worry about them. Then you have just-in-time systems, where we already understand just-in-time is just eliminate the extra inventory at the floor, right? So means you buy and you get things and you pay things only when it's actually required within an hour. So you don't really have to keep any high inventory in your stores. They're a very minimal one, so that you don't have to have a warehouse, or you don't have to have the high carrying cost of the inventory. Ideally, you build your supply chain and you build the excess capacity in your suppliers. So items are kept by supplier, not by you, right? So they are the one who are bearing the cost of carrying the inventory. You have to make sure that it's robust enough and they are able to deliver within the time, right? And you always have to have a backup of in case anything go wrong with the supplier. It works best with large manufacturer because they are in a position to bargain. Smaller ones, they may not be able to bargain, and it works poorly when you don't have a control over your suppliers. If you have a stronger control, then it works. Okay, then we look at cash management. Cash management, this one we are just going to look at very briefly. We know how to prepare the cash flow now because we have been doing the capital budgeting module, where we see how we calculate the cash requirements using the free cash flow model, right? The sale minus the expenses and minus the changes in the working capital and renovation. So basically we are preparing the cash same, but how do we manage the cash? That's the principal questions. So the motivation to hold the high cash usually is the transactions balance you need to keep in your accounts. Sometimes the bank is mandating that you need to have a minimum balance of $50,000 or $10,000 depending on what type of account you are actually maintaining. Also, you need to meet your day-to-day needs, because there are certain expenses which you have to pay before anybody else is paying you. Your daily expense, your petrol, fuel, electricity, your salary and other things. And then there are certain precautionary balances. You also have to have some balances to meet your unexpected needs. So normally how the companies do is they normally calculate an annual expense, the whole year expense, right? And then they say, okay, what is my per day expense? Let's say my per day expense comes to, let's say $100, right, on an average. If my AR holding days, if my AR collection days is, let's say 30, it means I'm able to collect within 30 days from my cash conversion cycle, which we discussed earlier. Remember the cash conversion cycle? So if my cash conversion cycle is, let's say 20 days, so means I need to keep a minimum of 20 days into $100, $2,000 at any point of time in my balance so that I can survive for the time that we are able to get the money from, right? So this is the minimum balance that you need to keep in your cash. You don't want to keep more than that, because if you keep higher cash balance, you will be suffering with no returns, right? Then the compensate the uncertainties associated with this cash flow means that the company need to also look at, are there any sudden payments? So looking at the last 1 year or last 6 months cash flow, you can see, are there any sudden cash requirements? If yes, how often are they, right? And what was a short notice that you might have seen in the past? With your experience, if you will not be able to plan this uncertainty, because there's no way you can understand the coming challenges. But by looking at the past records, by experience, you would know, okay, maybe sometime I get a special request to pay, let's say $10,000 or $5,000 on a short notice because of whatever reasons are there. So you may want to keep that balance not in the cash, not in the liquid cash, but in a bank, maybe in a fixed deposit which can be broken easily. You don't lose the return part, but you keep the money in liquidated securities. And then you have the compensating balance, because to satisfy the bank requirements that we discussed already, sometimes we companies take loan from the bank, and they mandate that you have to maintain a certain balance in your bank books, so that they are comfortable that you will be able to repay the interest part at least. That depends on the bank requirements. You cannot plan it out. It depends on the negotiations with the bank. Okay, the second part of the cash management is to understand three things. One is the cash holding days. So as I discussed with you already, the cash holding days basically is the cash balance divided by average cash expense plus the average supplier payment. So it will help you to understand how many days of cash you are holding. It should not normally be higher than your cash conversion cycle, because if it's more than your cash conversion cycle, it means you are holding too much cash, right? So you always have to monitor what is your cash balance at the end of maybe every 15 days or 7 days or month, depending on what is the cash situation with your company. If let's say it's a high moving transaction, means you continue to receive a lot of cash transactions every day, and you're collecting money every day and you're paying every day a lot of money, then you may have to look at it every day. Make sure you're not keeping a very high balance in the cash. Also have to make a cash budget, especially for the seasonal companies, and where the business is not really standard, right? You may have good business in 1 month, another one is not so good, then another month is very good. So you need to make a cash planning at least 3 to 6 months. That is the recommended time for making cash budget, 6 months. But you can go beyond if you have the visibility, but normally up to 6 months is the max, because you cannot look at the future with very details, right? So that you can identify, is there any extra cash that you have and any shortage of the cash that you need to provide for. Now what are you going to do with the cash extras? So then the next decision is what I do with the extra cash and shortage, right? So extra cash, normally you have to put in alternative investments. It can be your fixed bank deposits. You can borrow me, you can lend it to me if you want extra cash, no problem. Then also you may also see, is there any government securities which are liquid on or put into the safer securities. If your company allows, you can put into the debt securities over the stock exchange. There are certain mutual funds which maintain debt only, so they are not risky, right? Like a market price, like on a stock exchange. So certain companies, they don't allow investment into stock exchange, but they allow companies to invest into debt securities like the debentures or commercial papers, bonds that we discussed the other day, treasury bonds in US. Similar like those European countries also issue bonds. Asian countries, some of the Asian countries are also issuing bonds. The governments are issuing bonds. So the companies can always invest into those securities and keep use of cash to some extent, and they are highly liquid, so it's easy, whenever they want to sell, they can get the cash. That's the cash management. The money market options, which if the business has extra cash, they can use these ones to put the money. So treasury bills depend on how many days you have. They are usually available for 4 weeks, 3 months, or 52 weeks. There are certificate of deposit issued by the banks, so they have some minimum amount, minimum denomination of $100,000 if you have that much of money, right? There are repurchase agreements or bankers acceptance. Also there are certain money market options that companies can buy, commercial papers, and short-term tax exempt investments, but they are debt investments, right? So these are the usual options that the company has if they have extra money. Now if they don't have extra money, how are they going to find the money? So that one we will discuss in our next slide. So you can see the short-term financing, right? Basically, as I said, in the cash management, the most important part is to keep your minimum cash, not maximum, no, minimum cash in your hands. Invest extra cash in money market securities and plan the cash for next 3 to 6 months, so that you can understand how much forecasting you need. So the first step in short-term financing is to look at the forecast, the future cash flows, to discover a cash surplus or a cash deficit. Is that temporary or a permanent? Means temporary means it is only for 1 month, 2 months, and you will be able to recover the money immediately, or it's more of a permanent nature, means you need money for 6 months or maybe a year, right? So that is the two important things for any business to identify. So now let's look at presentation file. I would suggest you open the presentation file because the example. So let's look at one example of quarterly cash flow from one of the companies. It's just an example of the companies, right? So here in this case, what you see is the last quarter, what was their income. So their net income was 1,683. If you see, they are having a cash total sales. The moment the quarterly sale is fixed, right? The cost of sales is fixed, the EBITDA is fixed every quarter, EBIT is fixed every quarter, taxes are fixed every quarter, net income is fixed, and the depreciation amount is fixed. The only thing slightly changing is the account receivable, right? And then the cash from operating activities is there, capital expenditures there. So means the company is making a extra cash of $400 or $488 every quarter. So here you don't really have a problem, correct? There is no cash requirement. You just only have extra cash of $488,000 every quarter to invest. So you can invest it easily, right? So that's how a cash budget is done. In typically, you need to identify your income, expenses, EBITDA, then change in the working capital requirements, capital expenditure requirements, and also if you have any financing. That's a template for cash budget. So now let's say their quarterly net income is $500,000, right? And then they will be able to fund their sales growth on an ongoing basis. But there are certain times when you get negative cash flow stock. You may be temporarily negative because of any reason, or you may be in a seasonal requirement. You are becoming negative in terms of operations. So there's a certain negative cash shock where you may see unexpected cash outflow or cash inflows as well. The only thing is you need to be able to invest that money in a proper manner, right? Then there are seasonalities. When the business is concentrated on a few months, then cash is seasonal. In the previous table, we assumed sales to be uniform, right? So we were able to have extra cash on a seasonal basis, right? But let's assume there is a cash requirement here. Let's look at this one where you have a seasonal sale. Now you don't have the sales, right, every quarter. So here is a quarterly sale. So you have a maximum sale only in November and December, means quarter 4. You have the highest sale. The other sales are pretty much similar, right? In the first quarter are flat usually. So if you look at this, you have quarter 1 which has a slightly higher sale, quarter 2 and 3 which is very low sale, and quarter 4 which is the highest. It's similar to the hospitality industry, unfortunately, where I'm working now, where you have quarter 2 and quarter 3, i.e. April to June is a very slow, very soft season, very low income, and then in quarter 4 and quarter 1 is the highest. First thing we have to again do is identify the cash budget. This company is preparing on a quarterly basis. You can prepare on a monthly basis as well to understand which month you exactly require the money for. Cost of goods sold and selling expenses, EBITDA, identify the depreciation is going to be fixed, then EBIT, taxes, net depreciation, and then you will add the depreciation part so that you know. Then you have the changes in the working capital, account receivable. When you have high sale, the next quarter your account receivable will show a positive amount because you are able to recover the money. But when you have a lower sale, then you will not be able to recover that much or not a very high amount. But when you increase in the sale, it means you will not be able to recover the money for everything, so you have to have a minus. So we will show you with an example how to estimate the account receivable or inventory changes in the working capital is there. So you get the cash from operating activities. So you can see now the first quarter is plus, right, extra money. Second quarter is minus 947, third quarter is minus 1000, and fourth quarter again plus. So it's a temporary need. Then you have capital expenditure, and the total requirements is required as 1700 plus minus 1447 minus 2000 and plus 3400. So in a nutshell, in total for a whole year, they don't need money. Quarter one is plus, quarter two is minus. There is a wrong sign. They are missing the sign here. So it's minus 947 minus 500. So it should be minus 1447. Quarter one is also plus. Quarter two is minus. Quarter three is minus. Quarter four is plus. So quarter one they have 1700 which they can use in quarter two, correct? I mean they are able to generate 1700. So they will need that. They can use that money in quarter two, but then they will have only 300 left, right, for quarter three. And in total quarter three you need 2000. So your actual cash requirement to borrow from outside will be in quarter three. Now in quarter two you need only 1400. So you have more than enough at the moment because you already earned in quarter one, correct? So you don't need to borrow money from outside. But you, even though it's negative 1 minus 1447, so you will still be left with $300 left, right, from quarter one, because you have used 1400 in quarter two. You are left with 300. In quarter three you need 2000, means you are short by 1700. So you need to fill up this requirement from the short-term financing. There are many ways of short-term financing which we will look at in the future slides, but for the time being let's assume we need to arrange. In quarter four they are plus again, but if you add all of them in an overall year they are still positive, correct? So if you look at the annual financial statement, you will say they are positive, right? There's no problem, they don't need money actually. When you look at by quarter or when you look at by month, there may be certain months where you may need money, right, for a short period of time. So if we are focusing only on annual financial statements, we will not be able to understand. But if we are focusing on a quarterly or a monthly monthly cash flow statement, then we will understand in which month or which quarter the company has too much cash which they need to invest, and in which month they are short, means they need to borrow the money. So that's how we prepare a cash budget, basically estimate the cash requirements. How we prepare the cash budget? The budget we prepare by forecasting the cash inflows and outflows. You can estimate the sales and expenses, P&L every month, right, or a quarterly basis, and then the other cash disbursement, maybe selling expenses, interest, capital expenditure. So normally the companies, what they don't plan is the capital expenditure and also the changes in the working capital. That's usually they will take only direct cash expenses. They normally don't consider the interest, tax, or the capital expenditures, but they need to also add that into the cash flow. This is how you can estimate the AR, right? So for example, here you will see the beginning receivables are 3200. In quarter one, you make a sale of 4000, and let's assume you are able to 70% cash collection from the sales. So 70% of cash collection will be what? Say 4000 into 70% is what? 2800, right? So this is an example of setting up the budget for cash collections. Because cash collections, when you are doing a credit sale and when you are also doing a cash sale, it's a bit hard to understand the cash collections, right? So the cash collections, we will assume that you will receive the prior year quarter money in this quarter, depending on what is your cash collection cycle, right? If you are able to collect within 30 days or within the due dates, then it means the last month sale you will be able to collect in this month or next month. So you have to estimate in which month you are going to get that amount. You have to make sales estimate. So in this case is 4000, 2000, 2000 and 1000, 12,000. And then you need to make a judgment in this particular month how much will be the cash sale and how much will be the credit sale. So if the cash sale, you just add to the cash collection of your receivables, and then the balance amount will go as a receivable, right, for the next quarter to be collected. So in this case is 30% of line number 3, which is the sale of this quarter, will be the ending receivables. So you have an opening balance, you have new sales, you have the cash collections, the balancing is the ending receivables. So 3000 plus 4000 minus 6000, right? So here then 1200 will be the opening balance. This quarter again we are selling 2000 and we are able to collect 70% of this. 2000 means 1400. So total cash collection become 2600, the prior one, and 70% of this, and 30% of the sales will become the future cash. Then you will have the quarter 3 as a ending receivable. And then now to put into the cash, you cannot use this amount because you are not using if you are using the direct cash flow method. Here in this one we are using the indirect method. Remember, there are two methods of doing a cash flow. One is direct method, one is indirect method. In this example we are using the indirect method, right? Using the P&L, adding the changes in the working capital. Direct method will say not the sales but the cash collections. So here you have the cash collections, correct? But in indirect method we will look at what is the change in the working capital. So here the change is 1200 minus 1200, the 3200 minus 1200. So you are able to gain extra money around 1073. Then you gain $600 because your account receivable are less. This quarter to this quarter there is no change, so you will have no minus. This quarter to this quarter there is a 3000 increase in the account receivable, so means you lose $3000 from your cash flow. Similar way you can make a plan for the payment to suppliers. The important key is here is the details. If you put every item into detail like this, like last quarter AP, then this quarter payments, then what is the billing to suppliers, how much is the left amount that you have total in payments, then you will be able to clear it out easily. Otherwise it will be very difficult. So here is the direct method. You can see this is the direct method of looking at the cash flows, right? Cash collections which we get from the AR budget, 6000, 2600, 2900, 9000. Payment to suppliers come from here. SG and taxes come from another table. Capital expenditure came from the cash budget. Total disbursement and the net cash flow. So it's the same net cash outflow which we got from this table, but this is shorter because we are not really putting everything in like this in detail. We are just taking a direct route, putting cash collections and putting the cash disbursements, which are coming from different other supporting calculations. So you will get the same result. It's up to your convenience which one you want to use. You want to use the indirect method or direct method. So the supplier ledger says that previous balance is 477. This quarter's payment is 2700. So total payments that we are making is 3200. So that's how you will see the balance, right? And then you are ending. This is how you calculate the cash budget. I mean, you can calculate the cash budget and then you can try to put the requirements here. So let's say your opening cash balance is $1000, right? You get 1700 from here, you get 1700 from here. So your ending cash balance is 2763. You need a minimum of $500 minimum. You cannot spend this. So your extra amount is only 2200. But that is just only a cash planning, how much cash you really need in this month. Next quarter your opening balance is 2763, which is coming from the line number 4. Your net cash outflow is minus 1447. Since you already have the money, your cash balance is still 1300, right? The minimum amount you need to maintain is 500, so you have extra only $800. Again, minus 1316, the opening balance of the previous quarter, minus 2000, so you need $700. If you look at this, you need only $700. But since you need to make a minimum cash balance of 500 also, your actual cash loan requirement is minus 1231. So which one you will borrow, 700 or 1200? Based on the actual cash balance you need only 731, and based on the line number 6 you need 1231. And what is the minimum cash balance requirement is going to be used for? It's used for emergency, right? Or day-to-day operations. So you will not borrow only 731, because if you arrange 731, at some point of time your cash balance will fall to zero, right? You don't have any money to pay to anyone, correct? No cash expenses. So that's why you will borrow 1231, so that even after paying all the money you still have $500 balance in your quarter 4, right? So if you borrow that amount, this amount will increase to 500. But at the moment, normally, if just continuing with the cash flow is minus 731, your net cash inflow is 3000 in this quarter, right? So your balance is again 2671. So you have extra balance. For quarter 4 also, we know what is there any extra need that we need. If this also become minus, then we will need extra money, right? So this is how we prepare the cash budget. Steps of preparing the cash budget to understand what are our short-term financing needs. So this will help you to understand whether it's a short-term requirement. If short-term requirement, how short it is. Is it for 3 months only, or is it for 6 months, or is it for 9 years, for entire year? So based on that, you can try to find the money. Now, how we are going to find the money? In the finding the money, you will follow the matching principle. So matching principle says, for short-term needs, you will take a short-term loan. For long-term needs, you will take a long-term note. You will not do the other way around, right? You will not meet your short-term needs by taking a long-term loan, because then you are paying the extra and unnecessary interest. And you will not meet your long-term needs with short-term loans, because in that case, you have to find the loan again and again and again every time, right? So that's the important thing. So in the matching principle, yesterday also I discussed the two concepts, the permanent working capital and temporary working capital. Remember, we looked at there are two ways of financing the working capital. One is permanent, means taking a long-term loan, and one is the short-term, right? By taking on the minimum amount, rest of it we arrange by short-term needs. So in this particular case, we will need only a small amount, right? So we don't need to fund our working capital to the fullest, i.e. we maintain a high cash balance, right? We don't need that. We need to maintain only a smaller cash balance, so that only 1 month or 2 month cash needs, we can take the loan and then settle it out. The rest, we don't need extra money. So we will invest extra money in our other temporary measures, like money market instrument that I showed earlier. So this is your working capital. Basically, you have 500 cash balance minimum. You have account receivable balance, which is coming from another side, your inventory balance, and your net accounts payable. So this is your total net working capital requirement in each quarter, right? 3,500, 2,100, 3,400, 5,400, and then 3,875. So you have a varying requirement now. It's not a permanent requirement, right? So how much, what is your policy? What would you say that, okay, how much I need to keep in the balance all the time, and then increase or decrease based on the requirements? What is your thought? How will you do it? So there are two ways to do it. One is aggressive financing policy and conservative financing policy. So here is an example of aggressive financing policy. Means we identify the minimum requirements. So in this case, our minimum requirement is what? 21,000, right? So this is minimum that we need. So here we will serve only up to this need, and then the rest is based on the short-term financing. Take the long-term financing only up to the minimum level, which is 25,000, and anything extra will be coming from short-term financing needs. So that is called the aggressive financing, because you are not covering the minimum requirements here. Conservative financing policy means all the working capital is financed by the long-term debt. So the maximum amount. So here is the maximum amount. So you will take the maximum, and extra is keep in cash, right? So that's the excess cash. So always you have excess cash here, 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 and here. But in this case, you are not having an excess cash. You have only the inventory. You understand these two? Let's identify these are our financing requirements, right? So if you total up only the three first, let's say the minimum cash balance, cash, account receivable, and inventory. We don't consider for the time being the account receivable, right? So this is your minimum requirement that you need in terms of working capital. You have two choices here. One choice is finance only 2,125. And the rest of the amount that you are saying, the difference between 2000 and 3005, 3004, 5000 will come from short-term financing. This is one way of cash working capital financing, because you need money, right? So you will put the long-term financing only up to this requirement. Other way, which is conservative way, is to take a financing up to 5,425, because that is your maximum requirement. You will take a full-term loan of 5,400, but in that case, you have extra money lying around for 3 quarters, where 3,800 will minus 5,400. 3,400 minus 2,000, 5,400, and 2,000 minus 5,400. So these are extra cash. So they are the two extremes of financing the policy. Third method of financing the working capital is to take an average. What would be the average? Can anybody calculate? 3,5 plus 2,1 plus 3,4 plus 5,4 plus 3,8. 3,699. So let's say the company decide that we will take a long-term financing of about 3,700, right? 3,699. So let's round it off to 3,700. So let's say they arrange 3,700 as the long-term financing, correct? When we need 3,500, they are okay, correct? Because they will have some extra money, but not too much, only $100. In quarter one, they don't need that much of amount, so they need only 2,100. So means they have extra cash of 3,700 minus 2,100 to 1,500, right? Then in quarter two, again they are okay because they don't need to borrow anything. They are below their working capital. They are covered by their financing. But in quarter three, they are not covered, right? They need some money extra. So then in that case, they will borrow on a short-term basis. And also they will borrow the money, small money in quarter four as well. Financing is 3,700, but they need 3,875. So this is how the companies normally manage their working capital requirements, by doing the three-way of policy. One is aggressive, arrange only 2,125, and conservative, arrange 5,425, or compromise, take an average 3,700. Now we have covered the cash budget, how we estimate the cash budget, how do we identify the working capital financing requirements, and the two policies. Now let's look at some of the cash short-term financing that we need, how we meet our short-term financing needs, right, with the bank. So there are, one way is short-term financing through the bank loans. So there are certain single end of the period payment loans, means you take a loan and you say, okay, at the end of the period I will repay with the interest. So there's a benchmark rate such as a prime rate or a LIBOR rate. And the other way is to create a line of credit, means you don't really take a loan, you are just creating a line that, okay, if I need, I will take. So there are two ways, right? There is a line of credit also has two types. Uncommitted means you are telling the bank, if I need, I will take. If I don't need, I will not take. Then there is a committed, means you are making sure to the bank that you will use this line of credit. Committed, you have to take that loan. You don't have a choice. If you don't take it, the bank will charge you the interest. Then you have a revolving line of credit, which means you take the loan, you repay, then you take again, then you repay again. So you don't need to take an approval all the time, one by again and again and again every year, right? And then you have an evergreen line of credit, means you just can go and borrow anytime from the bank. So there are different line of credits, they attract different expenses. Because line of credit is never free. You have to pay a certain charge to keep the line of credit alive every year. Maybe a maintenance charge like 1%. In Myanmar, if you borrow the money, right, you have to pay 1% upfront fee, and then the yearly payment, right? So you have to repay at the end of the year, and then you borrow again, and then you repay again. That's how the Myanmar works. They don't have like a fixed line of credit where they continue to provide you the loan for long term. So they don't have like this. But in other countries, they have certain things called line of credit. You can take the money, you can return, you can take again, you can return again. You don't need to ask for application all the time. There are two options. You have a local financing, means because these are 1 year only, right? So you can take the local financing for short term, but the rate of interest can be higher than the foreign borrowing, right? Foreign borrowing you can maybe get at 5%, 6%. Local borrowings from the bank you maybe get around 10 to 11%. And you can also go into the unstructured market where they are charging around 50 to 20%. You have three scenarios, so you have to make the three scenarios. One is the conservative way. You just take only the minimum one, how much you have to pay in total financing cost, because it depends on how long you need the short-term financing, right? The second thing is you take the highest one, so it means you don't need the money at all, but you have extra money. Like if you have taken a loan on that highest money, you will be able to deposit the extra money in your bank account and earn some interest. so there will be some cost or offset it. So how much is your total financing cost in that scenario? Then you have a third scenario where you take an average and take a loan for the average amount. In some months you have extra, some months you have shortage. So what is your financing cost in total financing cost? The long-term financing plus also the short-term financing. How much is your total financing cost in all the three scenarios? And then you choose based on that. As a best practice, we take money to the average requirements. So we have some cash balance all the time to meet a couple of months cash requirements, but not too long, not too high. Okay. So then you have the other type of loans from the bank is called bridge loan, often discount loan with the fixed interest rate. With the discount loan, borrower pay the interest at the beginning, right? That is the bridge loan. And then there are usually some common loan fees like commitment fees, which is normally you have to pay a money for line of credit that you will use this. If you don't use that money, you will still have to pay some charge. You don't have to pay the full interest, but you have to pay a certain charge to not use the line of credit facilities. Then you have the loan origination fee. Normally is 1%, like a upfront. Whether you get the loan or if you get a loan, you will have to pay. There are sometimes the application fees with the bank, right? That you have to pay that fee no matter your loan is successful or not, because the bank will spend their resources and energy in evaluating the requirements of your loan. They sometimes charge money for making an application. Small fee though. Then they have compensating balance requirements. If you take a loan from the bank, they will dictate that you need to keep certain amount of money in their bank account, in a saving account or in a current account. Normally in a current account, not in a saving account, so that they have certain money in order to recover the interest immediately. Okay, so it's an example of commitment fee. Normally, let's say if you have on unused proportion, you have to pay certain fee, right? 0.5% in commitment. So 0.5% is an EAR. So this line of credit with a 10% EAR, the commitment fee is 0.5. So the total cost is 81,000. So that's how you normally know the commitment fees, right? Then there is a loan origination fee, which is again as a percentage to the loan. And then also you have compensating balance requirements. The bank will ask you to keep a certain percentage in a current account, non-interest bearing account, which is called current accounts usually, right? So you have to keep that money, means you are getting only half of the money, right? So you have to calculate the interest on the net amount, not on the total amount, because you are paying the interest on full amount. Let's say in this case, the loan is $500,000 and you are paying 10% on 500,000. But because of the compensating requirements, you have to keep 50,000 in your current account, for which you are not getting any interest, right? So means you are paying 10% on 450,000 now, not on 500. So your interest rate will increase. Short-term financing, you can, if you are a very big corporate, then you can issue commercial paper for getting the short-term capital, but is usually not available for smaller companies. So it's available only to very large companies, and it's an unsecured debt. Usually it's cheaper than the bank loan. Minimum face value is $25,000 for per paper, and usually the buyers are the financial institutions, big financial institutions. The commercial papers are not usually traded off at stock exchange or with the small investors because of their high face value. We will not really go into deep detail of commercial paper because that is not applicable to general masses. But there are two type of commercial paper. You issue direct paper, means the firm sell directly to the investor, and there are dealer papers, means firm issue to the dealer and then dealer will issue it to the individual investors for a fee, because the company may not want to maintain or may not want to sell or invest into the selling of commercial papers. Other one is short-term financing with a secured. This normally the same thing as the other financing, but here you just need to do a collateralization. So the collateralization, depending on the bank regulations, can be the fixed assets or it can be the receivables or inventory. So it's not have to be a fixed. In Myanmar, you can do only the fixed assets. Some banks allow you to put your inventory, which is movable but identifiable, as a collateral, or your other movable items such as like generator or TV or fridge you have both options available. Most common source of the secured financing are your commercial banks and microfinance companies. But microfinance or the factors is company that they will buy your receivable in exchange of a commission, right? In, for example, here in Myanmar you have a Chopay, which is buying the invoices at a discount, and then they will recover by themselves, right? But the ultimate responsibility still lies with the company if they are not able to recover. So you can put account receivable as a collateral, and normally they have their own standards of who they want to accept as a collateral, right? So they will look at the credit facility, they will look at the history of payment from the supplier, they will do a credit assessment of the customer itself as well before they give you the loan, right? Then you have a factor who normally are selling due to the at a fee. So usually it's about 1% to 2%, depending on what is the risk, right? So there are two types. One is with recourse, means if they are not able to collect for customer, then you have to pay. Without recourse means that if your customer don't pay them the money, then you also don't have to pay. So the risk falls to the factor. In that case, the discounting is much higher than the normal discounting is lying with the factor. So factor also will have to see whether he will be able to recover the money from the customer or not. You have sometime inventory also as a collateral. So inventory means you have a floating lien, means whatever comes in your inventory, it will be under collateral already. So they don't really fix the amount, or they don't really fix the equipments, or they don't really fix the items, right? There are certain times like fixed lien. So you normally have fixed amount of inventory which is under lien, and they identify and they tag that this inventory is now collateralized with certain company. But normally collateral does not mean that you cannot sell the inventory. You can still sell it and replace with something else with the same asset. With the general inventory, floating lien or general lien, you can sell and you can do whatever you want to do, but you have to take the insurance for the inventory, and also you have to make sure your inventory does not fall below a certain value. So normally there are banks who are auditing all the time in your premises to make sure that the inventory is still within minimum value that they want to keep, and you always have to inform the bank if there's any incidents in the inventory. Okay, and sometimes they take the warehouse arrangements. Your collateral items will be put into a separate warehouse. You don't have a direct control, and anytime you want to issue from that warehouse, you have to pay the bank, right? So it can be a public warehouse or can be a field warehouse. If let's say we have now understood the ending cash balance of company, and they have taken a loan of 1231, existing short-term financing is there, and then the total short-term financing will be only 1200, so they can arrange the money like this. So their minimum cash balance will be 500 and 2600. So this is how the short-term financing works.